There's a concept that was coined sometime in the late 20-teens that really took off in the early 2020s called the millennial lifestyle subsidy. And that term refers to a period in the early 20-teens when a bunch of tech-focused startups started throwing money at mostly people of a certain age living in larger and medium-sized cities, primarily in the US and Europe, but not exclusively, and they were spending gobs of money to reduce the prices on their services. So a company like Uber, for instance, would artificially reduce the price of a ride in one of their cars, one of the cars signed up to work for their service. And so the driver would get paid X amount, you would pay X amount, but often they would lose money on that trip. And this was part of a larger strategy that predominated at the time because the prevailing wisdom in the tech-centered, mostly Silicon Valley-derived startup company world was that you needed to spend a bunch of money and just hyper-scale as quickly as possible, attract as many subscribers or customers as you possibly can to just dominate a market and put everybody else in that market out of business so you can build a moat around yourself early on. And if you have to spend tons of money to do that, to artificially deflate your prices, that's worth the expense. And so companies like Uber were spending $1 million a week in San Francisco alone just to put its potential competitors out of business and to get as many people as possible reliant on their service as they could during that period. And the idea behind this business model is to spend investor cash, money handed to you by outside parties that benefit if you scale up and become big. If you become the next Amazon, they really benefit. And what that cash does is provide you a runway for eventual takeoff, usually either being acquired by another company for a huge multiple of what all those investors put in, or an IPO, going on the stock market and then allowing all of those investors to cash out just via a different mechanism. This was a business model that was enabled in a lot of ways by something called ZIRP, zero interest rate policy. And zero interest rate policy refers to a state of affairs in which there's not necessarily zero interest rate in terms of borrowing money, but close to it. And during this period, it was incredibly inexpensive to borrow money in the United States. So 1%, 2%, it was incredibly inexpensive to get your hands on debt, essentially, if you were one of these companies. So in addition to taking on investment, you could also take on debt, and that would further pave that runway that you have, leading towards your eventual, hopefully at least, takeoff, IPO, or sale to another company. The United States Federal Reserve started raising their key interest rate. And a little economic aside here, if some of these terms don't make sense, the US Fed has a couple of levers that it can use in order to adjust things within the United States economy. Their key lever that they use in order to adjust things is a key interest rate. They set a target interest rate for money that banks loan each other. That's not super important though. What's important is to understand that that key interest rate range that they set then goes on to inform all of the other interest rates. So the interest rate on a loan that you take out for school or for a car, the interest rate on your mortgage, essentially anything that you might do borrowing related for which there's an interest rate is at least partially influenced by this key interest rate that the Fed manipulates in order to get the outcomes that they want to see. But in the wake of the height of the COVID-19 pandemic, during which the economy collapsed and the government did a whole lot in order to keep things going, they injected a ton of money into the United States economy. There was a lot of inflation caused probably in part by all those injections, but also other things going on around the world. Supply chain snarls and crises. There was the invasion of Ukraine by Russia, which messed up a whole lot of energy markets. There were a lot of reasons for inflation to pop all around the world. And part of what the Fed can do, using this key interest rate range that they set, is make it more expensive to borrow money, which then leads to less money being borrowed, thus less economic activity, fewer companies hiring tons of people and investing in infrastructure, fewer people taking out loans to get cars or getting mortgages to buy homes. It cools the economy, and that then in turn tends to secondarily lead to reduced inflation. So at the moment, they are coming down from a recent peak of 9.1% in, I believe it was June of 2022. They've got it down to around 3% now, but they're trying to get it down to 2%. So that's the state that we're in now. It's been a couple of years now that we've been living in this post-zero interest rate economy. And that consequently has led to a flurry of activity in startup spaces in particular, but really across the global economy. A lot of companies that relied on this type of debt suddenly didn't have as big a runway as they had anticipated. So they laid off a whole lot of people, halted a whole lot of investments that they were making, and they tried to right-size, basically. Big companies did this that are already established, but so did all these companies that were aiming for an acquisition or IPO exit. They are now trying to get profitable. They're trying to tidy up their books and make sure they bring in more than they expend, and that's difficult to do when you're coming from that previous paradigm in which you're trying to spend with the hope that someday you can raise all your prices and people will be so dependent on you, they won't be able to do anything about it. So that sets the stage for where we were during the millennial lifestyle subsidy era, where a lot of us were getting tons of free stuff and a lot of subsidized stuff and a lot of cheap stuff. But now we're entering an era where that is no longer the case and prices are going up. Now, in parallel to this, outside the US and other similar markets, we're seeing a major shift in China and the larger Southeast Asian region as well. Back in the day, in the 1970s in particular, China introduced a whole lot of new policies and laws that allowed them to rearrange their economic system from what it was before, to introduce things like tax rebates and special economic zones, and allegedly a bit of currency manipulation to help them get their economic system on track from something that was definitely not on track for a very long time. This worked incredibly well. From the late 1970s till today, they've managed to bring an estimated 800 million people out of extreme poverty. It's one of the biggest economic successes in human history, arguably. And part of that economic miracle came down to turning China into essentially the factory of the world. This is why, from the 80s and 90s onward in particular, a whole lot of companies from around the world started to outsource all or most of their manufacturing to China. It was just way, way cheaper to have their stuff made there and then shipped across the ocean than it was to build the stuff in country. And part of the reason it was so inexpensive to deal with China is, one, all that government support for their companies there, but two, they just barely paid people anything. They were able to pull people out of abject poverty and still pay them something that would be a pittance in the wealthier world. And that kind of arbitrage served everyone, more or less, for a very long time, for decades, especially the past 2 decades, because it was around the year 2000 that China's model really allowed it to take a position of prominence in the global economy. In recent years, though, Chinese businesses and individual Chinese people have started to move up the value chain. They've got a lot of people who are not just laborers, they are very skilled laborers. They have manufactories that are not just low-level manufactories churning out a bunch of whatevers. They can produce very high-end sophisticated goods. And that means they can charge much higher prices, both these businesses and these individual laborers, these workers. So now these Chinese workers are demanding higher salaries, and the average pay that a worker in China brings home has increased by 122% from 2012 to 2021. That's a pretty substantial improvement, but it's made it a whole lot more difficult for the Chinese government and those businesses that operate under them to sell themselves as the world's factory, because suddenly it's not such a hugely discounted deal to build your stuff there anymore. That has led to a whole lot of that manufacturing work flooding outward throughout Southeast Asia. And a lot of other countries have benefited from this, but perhaps especially Vietnam and India. And India is a little bit behind Vietnam in this to a certain degree. Vietnam has been absolutely killing it in this regard, picking up a lot of these manufacturing jobs that the Chinese didn't want anymore or that they couldn't get their prices low enough anymore. But in Vietnam, too, workers are starting to demand higher wages, and for the same reason that workers in China began to do the same a couple of decades ago. Factory work wages in Vietnam have more than doubled since 2011. And today, they're up to about $320 a month on average. So this sequence of events, where overseas companies are looking for cheap manufacturing, keep going to cheaper and cheaper places, but then workers in those places are able to move up the value chain and become more skilled, are able to demand more for their labor, is making it incredibly difficult for these companies to get the kind of discount that they were able to rely upon just a couple of decades ago. And this has led to a situation where we're beginning to see all that offshoring start to reverse. We're seeing reshoring and nearshoring and friendshoring, which are all different words for similar things, bringing these manufacturing jobs back to within one's own borders, bringing it to closer countries like the United States, nearshoring with Mexico, hiring people to do that type of work there. And then there's friendshoring, which is bringing those manufacturing jobs to military allies, so that if something goes sideways militarily and somebody invades somebody else, you don't lose that manufacturing hub, which could be a serious security issue. Despite all those attempts to find better deals in near and allied countries, we're still starting to see prices go up on a lot of goods that until recently were just incredibly ultra cheap. But the reason for this price increase on a lot of these goods that many of us have come to take for granted as always being cheap and widely available is that more people in more places around the world at different levels on these supply and value chains are getting paid living equitable wages. There's a recalibration then that's bringing some of these prices into better alignment with the economic and social realities of the day. And just like the millennium lifestyle subsidy era ended with a recalibration of economic circumstances that took into account all of that inflation, and that took into account the fact that this was not a sustainable way of doing business and competing. The entities in a lot of these spaces, making gadgets and gizmos, making fast fashion clothing, are having to scramble to adjust their business model and in some cases their products as well to take this new reality into account. So it will be an uncomfortable time for a lot of them and for a lot of us as well, but life will probably get a whole lot easier for people further down that supply chain. And though there's still a whole lot of work to do in that regard, especially if we look all the way down the chain to the people who are harvesting the raw materials used for a lot of these goods that we still do take for granted, whatever the price, there is a chance that this represents a kind of pivot point, after which we'll start to see fewer unsustainable business models and more business models that have to take into account all of these expenses, including expenses that were not previously considered to be important, because the people who are now in a better position to demand decent wages for their labor were not in the position to do so even just a couple of years ago. And of course, all of this could change again just as soon as the inflation situation changes, but for the time being at least, this is a remarkable moment in modern history during which folks at the bottom of the food chain have a whole lot more power than they typically do. And so many of them, including many groups of them, are doing what they can to lock in that power. And that will almost certainly cause some of these business models that are not able to roll with the punches and change with the times to go under.